Good afternoon, everyone. So I'm Abigail Dean, and I head up sustainability for the real estate affiliate of Nuveen. The real estate business of Nuveen is a global business. We're actually headquartered out of London, as you can probably tell from the strange accent. And we have offices in 23 cities globally. So for us, investing locally is really important, and understanding the DNA of a city is a really essential part of what we do. I'm going to start just with a couple of statistics that are really significant for me. There was a report out a few years ago by Cambridge University's Sustainability Leadership Institute, which estimated that the potential loss to global portfolio investment values from climate change-related market shifts was 45%. In 2017, Willis Towers Watson produced a report which said that the current annual loss related to climate change for US insurers was $50 billion. Now, I've worked at Nuveen Real Estate in sustainability for 2.5 years, and I've quoted those statistics time and time again, because I think they really encapsulate the magnitude of the challenge that climate change presents to investors. This year, I had to start using a new statistic, which is that in 2017, the global cost of climate change-related weather events was $330 billion. So this issue is not on the horizon. We're feeling this here and now, and we need to take it into account in our investment decision-making right now. So when we look at how to invest in real estate, we, like many others, are very focused on market cycles, and this is common across all asset classes. However, we know that impacting long-term structural demand for real estate are megatrends. And if you can focus on those megatrends, and that helps to protect value throughout market cycles. So that's things such as the rising middle classes, urbanization, climate change and technology, and aging population, and the shift of economic power from west to east. Now, some of those trends are going to increase demand for real estate, which is obviously positive for us. That's things such as the rise of the middle classes and growing urbanization. But other of those trends are going to change that demand. And that's climate change, that's technology, that's aging population, and the shift of economic power. And what that means is that certain types of real estate, certain asset classes, and certain locations are going to be more resilient to those global megatrends and are going to perform better against those global megatrends. So that's really significant for us in terms of how we think about this in our investment decision-making and how we deliver long-term sustainable income for our investors. Focusing down specifically on sustainability and picking up on climate change, I've highlighted 3 areas here. So as we make that transition to the low-carbon economy, which we see already happening, we start to see market shifts and more demand for zero-carbon buildings. All buildings will need to be net zero carbon by 2050 if we are to meet the commitment of the Paris Accord. That's going to create a massive change in the real estate sector, and buildings that cannot meet that demand are going to become obsolescent. So this is a really important, significant shift for real estate investors. Investors are going to want to decarbonize their portfolios, and we see this already with the rise of carbon divestment, and also with the increasing rise of the global real estate sustainability benchmark. Now, if you're not familiar with this, this is a real estate-specific benchmark that has been around for about 6 years. It now covers $3.6 trillion of real estate. About 75% of the world's largest REITs are covered by that, and 75% of IPE's largest real estate fund managers. We have seen a real significance placed on GRESB in recent years. Most of our third-party capital investors now demand that we take part in that benchmark annually, and some of them are demanding that we achieve certain levels of scores in that. And that is something that is new. That is a new trend that has come into the real estate market and shows that that low-carbon economy transition is already happening. We also see policy shifts. So governments are going to be moving buildings more and more towards that zero-carbon point. The physical impacts of climate change will have a significant impact on real estate value. We've seen the predictions from the UN and the IPCC in the last couple of months, but there's a really stark picture out there, particularly for real estate, coastal flooding, wildfire, severe storm damage. These things are already starting to have an impact, and unfortunately will do on an increasing basis in the years to come. But responsible property investment is not just about taking account of these structural megatrends. It's also about good environmental management within our own properties. It's about maximizing the socio-economic impact of our property. And finally, it's about looking at the health and well-being of the people in those buildings and how we can improve that. This session is about cities, and I want to take a step back and say, how do we at the moment define a sustainable city? Now, that's a challenging thing to do, and there is so much that you can look at, and we're only really starting to begin that process. But there are a couple of things that we do look at consistently, and this helps us to define our universe of sustainable cities. So we look at all of the megatrends and we apply a score and a weighting to all of those. Sustainability makes up a quarter of that score, and within that we look at these three key factors. That's air quality, that's climate change vulnerability, and those are grid carbon intensity. Now, the first two, air quality and climate change vulnerability, will have a specific impact on the value of property and the lives of the people that live in those cities. We want to know that the cities we invest into have got strategies in place to protect themselves from the worst impacts of climate change, and we want to know that they either already have good air quality or are improving that over time. The intensity of grid carbon is more about the transition risk and about the wants and desires of our investors, who are rapidly wanting to decarbonise their portfolios, and some of them quite ambitiously so. So investing in a building in a city like Paris, which already has a virtually zero carbon grid, is going to help them get there a lot quicker than investing in a city like Sydney, which, whilst it has incredibly energy efficient buildings, has a very coal intensive grid. What you can see here is the range of those scores for each city. So the blue bar shows you the range from the 25th to the 75th percentile. So a short clustering indicates a short bar indicates a clustering around a median point. So taking the US as an example for air quality, generally speaking, good air quality and a clustering in that green level. But then for grid carbon intensity, you can see a much wider range there. So we integrate these kinds of considerations throughout the investment life cycle, not just when we're selecting cities. It's built into our fund strategy through how we report to, give transparency to our investors through taking part in GRESB and UNPRI. When we're acquiring buildings, we assess how sustainable they are at that point and how much money we might need to invest in them to improve them. Through asset management, we gradually improve the sustainability performance of all of our buildings, focusing specifically on energy efficiency. And Capital Works presents a fantastic opportunity for us to really uplift the sustainability performance. And underpinning all of this is our target to reduce the energy intensity of our portfolio by 30% by 2030, which keeps us ahead of that trajectory set out by the Paris Accord. And you heard Vijay talk about that this morning. I do want to focus a little bit more specifically on the S, though. I've talked quite a lot about carbon and climate change, and I think climate change does have a fundamental impact on society and how we live. I'll give a few specific examples, though, looking at it from a slightly different angle. We're currently partway through a project to redevelop Edinburgh St James Shopping Centre. This is taking a much unloved and fairly ugly building. Fortunately, we've now knocked it down and are replacing it with the beautiful building that you can see behind me. So this is creating a proud addition to the Edinburgh cityscape and adding to its cultural and architectural heritage. And this is going to create about 140 retail units, 30 shops, Edinburgh's first everyman cinema and W Hotel. We've really focused on both the environmental and social elements of this project. It's going to create 3,000 jobs for Edinburgh. We've undertaken analysis of the economic impact on local businesses, which will be positive, and also looked at the level of pride that it's going to give to people in their city and addition to the public realm. 67% of the people who work in the construction site come from the local area, and we've also placed a real emphasis on local sourcing. Another new area focusing on the S, which is really fascinating for us, is the link between building attributes and human performance and health and well-being. There's been a huge amount of information that's come out about this in the last couple of years and research studies showing that people can perform 10 to 25% better when they can see views out of their window. They can process calls faster, although I'm not sure that I'd necessarily have that as a fundamental factor in improving human health. Hospital stays are 8.5% shorter. Increasing the amount of natural daylight makes people more productive. Increasing the amounts of natural air and improving air quality makes people healthier and work better. So this is a relatively new area for the built environment, but it's one that we're really enthusiastically embracing. A number of our new developments are getting accredited to something called the WELL standard, which is the gold standard in health and well-being for buildings. And we've also been rolling out sensors across our portfolio, looking at levels of natural light, air quality, noise, temperature, etc. So before we move on to the panel, and just to conclude, having worked in the sustainability space for over 13 years now, I have to say that the last few years, with the increasing significance that's being placed on ESG and sustainability by the investment community, gives me great optimism that this is going to, that real estate can really be part of the solution to some of the problems that we face as society. Thank you.